So this is just a quick disclosure, just representing that we are recording this, and this is for informational purposes only. It's not to be used as investment advice. So we'll keep going here. All right. So we'll go ahead and jump right in to really what is the bucket strategy? What is the purpose? What is really the main goal when it comes to setting up a strategy to withdraw money from your retirement accounts for retirement income? So the biggest thing is really consistency and reliability when it comes to staggering your withdrawals, making sure that you're taking out enough out of your retirement accounts to be able to support your lifestyle, but yet not deplete those accounts to the point where you aren't able to sustain that account balance or that nest egg really for the duration of your retirement, depending on how long that may last. So it can really impact a retirement when we are stuck with maybe taking out income for 30 plus years now, as people are beginning to live longer into their retirement years, and sustaining that to satisfy all of your retirement goals and just be able to provide for that lifestyle that you're looking for. So that first part, like I said, is just that consistency and reliability. The second part is discipline. So having a framework and being able to provide yourself with a consistent filter, really, to have decision-making ability when it comes to looking at things like down markets or economic turmoil. Those types of decisions can really weigh on us emotionally, and instead of having to fall back on those emotions, we can really have that process and that framework. Third, it provides efficiency. So, really, we have to make sure that we're putting assets in the right places to have tax efficiency, also withdrawal efficiency. So we're not, withdrawing from one account that might be taxable when we're not intending to pay those taxes on that distribution. So it becomes a really important factor to make sure that you're being efficient with those withdrawals as well. So without further ado, we'll go ahead and jump right into the first asset bucket here, which is uh, spoiler alerts. These are actually all just based on time frame. So there's no magic kind of design or really application to these other than what fits best in those particular time frames. So it's a simplified concept, but it's not an easy concept. Those are two different things. So we'll jump into the immediate bucket here and then really discuss what this is designed to do and help you with. So that immediate bucket really is that first 0 to 2 years of income needs. So when it comes to those immediate needs, making sure that we have stability, liquidity in our retirement. Really the most foundational, but really a very important part of that foundation. The main factor being is that having a solid foundation or having that solid uh, chest to pull from is going to provide you with that stability in those more risk on assets, such as those growth assets or things that are going to be invested in an actual equity portfolio that is designed to grow over the long term. So we know that those have volatility. So having that big amount of liquidity available to you is going to provide you with that stability to be able to sustain yourself in the long term. So really, there's about a 2 year buffer that is I'd say the most healthy funded amount of that first bucket to be able to provide you that full income amount for those first 0 to 2 years. And that's a time frame that we'll go into here in just a minute. Sometimes you might hear it referred to as a war chest, or really that amount of money that you have at your disposal if you need to. So it's designed for you to be able to have it for a purpose. It's not just kind of an amount that you just continue to sock money into until you want to get it as big as you possibly can. It has a purpose, and there is a limit to it that we'll go into. But you should have that ability there to know what the purpose is and to really speak to what that purpose can do for you. It also functions as your emergency fund, but also as a way to kind of stop emotionally withdrawing from any of the other buckets that might be tantalizing to you to be able to pull from. So case in point would be if you do have some risky assets in more of a growth purpose for your account. If we see some of those assets, increase in value, it might be tempting to go ahead and sell those assets as opposed to pulling from the first bucket, which is designed to provide you that income stream for those first 0 to 2 years. That's really what that's designed to do. So those assets should be in really high yielding savings accounts, something that's going to be safe, whether it's FDIC insurance or anything that's going to have that backing or that insurance. A credit union as well would have that ability to do that. So, and again, these assets are designated for just that safety. They're not designated for growth. They're going to be designed to give you that solid foundation. So we'd like to show you here is just a chart of why we kind of come up with that 2-year mark. So why 2 years? Why is that very important? Well, 2 years, that's really a statistical number. If we go back really into about the 40s, that gives us a design of how long it takes for us to really get out of most corrections or most down cycles in markets. So here, if we look at when are those real bad markets? How long do those last for? Well, we can look down at the bottom there. We see the really the orange bars. Those aren't necessarily when the market is dropping, from that peak down. It's just saying this is how long and this is how deep that those corrections are. Which, by the way, they are less and then also less severe than the bull markets are. But those bear markets, typically last, 11 to 12 months on average. There are some cases though where they can extend and, bring up that average. So we don't want to necessarily lean at just the average. We'd like to go above and beyond that a little bit. But 2 years is really about a safe bet. To kind of really ride out any of those market corrections in those cycles. So we like to stick with that 2-year window because if we did run into that really bad market and we're not able to really see any gains in some of our portfolios that are invested in the market, we have that war chest to be able to pull from. So it is a very important concept to be able to have from there. So next bucket here, we are going to go into really talking about the next step up, which is that kind of 2 to 3 year mark, what that entails. So assets that are in the short term bucket are going to really start getting into more more that are going to be designed to actually yield you something that's above and beyond what a savings account would yield you. So whether that's a money market instrument or a fixed term CD or bond, that's really what this is going to entail. So these accounts are really designed for revocable living trusts, assets that are not retirement accounts per se, joint accounts, individual accounts, things that you would pay tax on if those assets did appreciate in value. And the reason being is because if they do appreciate in value and you pay tax on those, whether it's dividends, interest, or capital gains, those assets can still be withdrawn without having to pay tax on that principal like a retirement account would. So these accounts are really designed to provide you with, what they call trickle income. So income that is going to continue to replenish that first bucket. Since we know that first bucket is going to be that first place that we pull from when it comes to retirement income needs, giving us, again, that war chest to pull from those assets. Well, that chest will need to be replenished at some point. So this bucket is going to continue to refill that next bucket as we continue to withdraw. This is designed to keep up with inflation. It's not designed to necessarily outpace inflation. So we do know that short-term rates do still follow the nominal rate of interest as the market continues to dictate that, which right now, as we are all aware, is fairly still elevated. We do see interest rates on money markets, on savings account paying over 5% right now still. That's not a normal rate of interest for a savings account. That is a high rate of interest. So we see that not only do we see those interest rates go up, but inflation will have that following marker with that. So we have to again make sure that we are keeping up with that inflation. But again, we're not really trying to outpace inflation at this point. We're just trying to make sure that our principal is not getting eroded away as we continue to invest that money. Potential investments in this bucket are going to include, again, very, very safe, very conservative investments, things like treasuries and CDs, money market accounts with, maybe some staggered maturities. And we'll go into that here in a minute. What does that kind of look like? In terms of our tax implications on this bucket, again, we're not, looking at necessarily any retirement accounts unless that's the bulk of your investment portfolio. We're going to be looking for those, non-IRA accounts, those things that, we can withdraw and actually use to replenish that bucket that has our savings money in it, that war chest money. This is just an example of how you would structure that second bucket if you were going to be going ahead and depositing money in there, and then withdrawing that money into that first bucket as things continue to mature in your retirement. So as we look at how to structure these, really we should have a laddered or a staggered approach to investing this money in that bucket. So this is an example of $1,000 that we invest periodically into a varied maturity type of a ladder. So a ladder, you can see here as we have the different rungs, are going to be maturing, and then we're actually just going to be putting that right back into that same maturity. So we know that interest rates will fluctuate based on time of time of when we're actually investing that money, and what the interest rate is at the particular time in the market. However, one thing that we're seeing is that money always is coming due periodically as those investments mature. So we are taking advantage of those laddered maturities. The reason being is because we are getting interest on that money as it's maturing. We're paying that money back into either this particular account if we're not withdrawing from bucket number one, or we are going ahead and we're waiting on that money to mature. And if we need to go ahead and refill a larger percentage of that money that's been taken out of bucket number one, we're actually just going to take more of that principal. So whether it's half, three quarters, or maybe even that whole CD or whatever had matured, and because that's now liquid, we can go ahead and transfer that over to that first bucket and begin to replenish that amount. That covers bucket number two. Bucket number three is really where we're getting into more of kind of that growth mindset as we get into this the next part of these two here. So really, when we're looking at this is going to be our medium term bucket. So our medium term bucket is going to be that 3 to 5 year window. These are going to be investments that are kind of going to be hugging the line a little bit in terms of that growth versus growth in income. These are going to be more into the retirement account space. So whether that's going to be your traditional IRAs, typically traditional 401ks, things that have a tax advantage, but maybe aren't necessarily completely tax free, but can give us some tax efficiency with some of those growth assets. So with bucket number three, again, the main characteristics of this one is we are designed, we are designing this bucket for a growth and income approach. So we're going to go ahead and we are going to shoot for outpacing inflation on this one. So we're not trying to just keep up with it. We want to take on, a little bit of risk, something that's going to allow us to capitalize on that reward for taking that risk and begin to really have a more of an outpacing or advancing above and beyond inflation at this point. We're going to be looking at diversification in this. This is key when it comes to setting up that right portfolio for the needs of the investor. So it's going to be a combination of those growth assets, which are typically going to be stocks, maybe some alternatives, could be real estate as well, but typically you're going to see mostly stocks. And then, that's going to be offset with those bond allocations, which are going to provide that stability, that reliability, to give you more of a consistent rate of return than just an equity portfolio. You might see this sometimes in the industry referred to as more of a balanced approach or a moderate approach. That's really just designed to tell you, hey, we're somewhere in the middle. We're not going to be, on one side or the other. We're going to, be taking on some risk, but not so much to where we're, not putting that principal at risk. So the easiest way to typically implement a lot of these portfolios is just going to be with an ETF or a mutual fund portfolio that has a low expense ratio. Those investments are going to be automatically diversified with how they are invested, depending on the objectives of the fund, who the fund manager is, really trying what they are trying to achieve. And a fixed income portfolio that is designed to meet that 3 to 5 year time frame. It should typically be matched with what that a concept that they call duration, and what that duration means is essentially you have not a whole lot of fluctuation in portfolio and principal value, regardless what happens with interest rates for your set time frame. So, case in point would be if you really need this money in say a 5 year time frame. You would choose a portfolio that has a duration of approximately that same time frame, and what that's going to do is that's going to make sure that whether interest rates drop and your principal of your bond would go up as it relates to the correlation between prices and interest rates, or if you have a higher rate of return on that investment and say interest rates go up and your bond prices drop, none of that affects the end value of your portfolio, and you're going to have approximately the same amount at the end of that time frame, regardless of what those interest rates do. So that concept is called immunization. So that's something that you would want to make sure that you have in place with some of these portfolios that have a bond allocation to them. Really, interest rates are going to be the main factor when it comes to that. Again, best use cases in terms of investment accounts for this particular bucket is going to be tax deferred accounts. So those accounts that have some tax advantage, but still, you would pay some tax if you were to withdraw that at retirement. So IRAs, 401ks are typically going to be your most common. Keep in mind that does also include simple IRAs through your employer plan, SEP IRAs, any 457s, 403bs as well, all carry that kind of tax deferred status. Again, growth is tax deferred, so you do get a tax advantage as it's growing. But again, those withdrawals are going to be taxed at retirement whenever those come out. So this chart here, we put together from JP Morgan. This is called the Guide to the Markets, which is a resource that we use, and allows us to really kind of pinpoint the advantage of that diversification piece that we really do shoot for as it relates to bucket number 3. So in the middle here, you can see where there is a line that really intersects through the middle of most of this chart here. And what that is referring to is it's just a diversified portfolio, typically of about a 60-40, which is your common kind of retirement income portfolio. 60% stock, 40% bonds, and the performance of that as it relates to all of the different asset classes that are in the investment universe. We see anything from large cap one year being up to commodities next year. There's just a very, very hard way to tell what asset class is going to be in favor from one year to the next. And the big takeaway here again is going to be that diversification piece, which allows you to, again, maybe not beat the market every single year, but definitely not going to get the worst returns every year as well. So that consistency and reliability is going to be prevalent in that particular diversified mix of those stocks and bonds. Lastly, here we're going to go into our long-term bucket. So this one is really what I think a lot of people think of when they think of investing or getting money into the market. This is where you see the money. The dollar signs go up. So the best way to do this, is if there is a very tax efficient way of doing it. We know that the more the money that we make, whether that's through appreciation, whether that's through dividends or income, that money is going to be taxed. And the more taxes we pay, the less our after-tax return becomes. We have to make sure that we're not subjecting our returns to so much tax that we end up getting a lesser return than we could just by buying a more conservative investment. So really, this bucket should be those growth assets, should be assets that are in a very tax efficient account, preferably tax free. The main three tax-free vehicles you're going to see out there are going to be your Roth IRA, your Roth 401k, and then if you have the ability to invest in a HSA. That has a brokerage window or something to invest in stocks into. Again, an HSA is going to allow you that tax-free status as well. So time frame, what are we looking at here as far as time frame? Well, if you have those assets in that account, try not to really kind of even consider them as part of your retirement income withdrawal strategy because they're not designed for income. These assets in this bucket are designed for growth. So a 5 to 10 year kind of expectation on those is usually what's going to allow you to keep those assets invested and do what they do best, and have that growth potential, be able to grow over that time frame that you are looking to put those to use for. And what's the main, purpose of that? Well, this is designed to continue to outpace inflation, but also to provide you growth above and beyond what that inflation rate is. Your after-tax return, or your after-tax inflation adjusted return, really is your real return. Because we know that inflation will erode away at that principal and that purchasing power over the time of your investment. So as far as your, kind of your investment choices, the flexibility of this one is really wide open, and so you don't have restrictions in far as because of the tax advantages of it. You don't have to have as much concern over exactly which assets you're putting in here. Choosing assets carefully is still important, and making sure that you are invested in the right places. However, having that tax sensitivity is not as prevalent as you're going to have in some of those other buckets. Again, we talked about mitigating that inflation risk, making sure that you're putting those assets in there that are going to grow. A conservative asset into a tax-free account really isn't going to give you a whole lot of benefit, because of the fact that you're not getting that appreciation, and you're not getting much of a tax liability, versus if you have something that's growing and you're going to have that appreciation potential there. So again, we talked about the kind of the more risky and tax inefficient assets are going to be a benefit here, but be careful if you kind of get into that speculative range. Things that are going to be very, very iffy in terms of the overall expected return. They could potentially benefit you as it relates to the tax savings, but when it comes to actually that investment quality itself, if that's not going to pay off for you, and that investment's not going to appreciate in value, and you're not expecting that to go up, well, we don't see any gains at all if something is going down in value. So regardless of what the tax savings are, not having that that growth is going to obviously negate any type of tax savings. When it comes to withdrawing this money, making sure that those accounts, those withdrawals are qualified is the best way to make sure that you're getting that tax-free advantage. So again, a couple stipulations when it comes to qualified Roth IRA, traditional IRA withdrawals. Typically those are going to include age 59 and a half. With a Roth IRA, you do have to make sure those assets are in that account at least 5 years before you withdraw any of those gains to get that tax-free growth on those. Again, best suited for those tax-free accounts, Roth IRAs, Roth 401ks, and then also HSAs. So, one of the questions right now is, we just actually hit, 40,000 today on the Dow Jones. Was a, very great day in the markets. Why don't we go ahead and sell those assets? It seems like a great time to sell. Why wouldn't we want to go ahead and do that? Well, again, we have to go back to the purpose of why we're investing and putting these assets in these particular tranches in these buckets. We, particularly with bucket number 4, need to make sure that those assets are invested, even when it is tempting to sell. So over here on the right, we see how important it is to make sure that we are aware of, just the behavior of the markets. So when it comes to investing, a stock peak usually leads to higher stock peaks. It's just a natural way, a characteristic of the market itself. And so, just because we are seeing those stock highs right now, that doesn't necessarily mean that's the best time to sell. So those should be, factored in with other types of things. But really what this chart over here is saying is, after we do see a stock peak, a lot of times those lead to higher highs. So 1 year after we see a stock peak, the compounded returns in the year after that is, over 12 to 14%. 3 years later, we see that average right around the mid tens. And then 5 years later, we still have the ability, or the probability of getting upwards of 9 to 10% on an average basis when it comes to those stock returns. So it is a testament to continuing to invest in the markets. The markets do what they do well, which is continue to grow, and we have to make sure that we are letting those assets grow for as long as they can. Even if we are tempted to go ahead and withdraw those assets when it comes to replenishing retirement income and those types of things, but following this structure again allows us to take advantage of times when we might want to go in and liquidate some of those positions, and I'll go into that in our next section here. So that's our four buckets. We've really touched on the main purposes, the asset types that best fit those accounts, the asset or the accounts themselves that are best suited for those buckets, and how to structure those. Now, one of the other things that we want to look at is those tax implications to withdrawing that money. So again, each bucket is taxed differently depending on which assets, which accounts you have in those particular buckets. Some of the main types of income you're going to see taxed are going to be the ordinary interest. Those are going to be things like the interest off of CDs, interest just on your normal cash on your account, and then dividends. So dividends are going to be taxed as ordinary income as well. So those are going to be your shareholder distributions from any stocks that you own. Same with like preferred stocks, if you have those dividends that are coming in. If you've held it, especially a stock for a short term, that's going to be taxed at just your normal ordinary income. Dividends or interest are taxed on the time that they actually get posted to your brokerage account. So, regardless if they're reinvested, if you leave them in the account, again, that tax payment is going to be reflected on your tax form, regardless of what you do with it after you receive that payment. So, considering the after-tax return, not just your gross amounts, are especially important with your if you're withdrawing from any tax-deferred accounts as well. Those amounts all get summed up towards the end of a year. Your brokerage custodian will send that form to the IRS, and then you'll be sending that to your tax preparer to make sure that they're reporting all of your retirement income from any type of retirement accounts. And so that amount will be taxable. It may be taxed less, it may be taxed more depending on your income, but you do want to make sure that you're mindful of what's actually coming out and being taxed for that eventual tax payments that you'd have to make. As far as the different tax implications on the different accounts, for bucket number one, there's really no need to have a separate account for some of those assets to go into, whether it's, a checking account that you want to maybe write checks out of, having that all in the same account is fine. You don't necessarily need to have a separate account for that money. Um, as it relates to bucket number two, one kind of trick that I think works pretty well when it comes to designating where those assets are going is that you can instruct your custodian to basically just say, "Hey, I want these assets paid into my first bucket, my war chest money, as they're paid out." What that does is that allows just that consistency of that income. You're seeing kind of that money coming into that account, and you're able to really find out what kind of that income stream looks like, and make sure your budgeting, your spending plan allows for all those assets that are coming in to be used appropriately, and that you're familiar with kind of what's coming in and where you kind of get that familiarity level with it as that happens. So again, your custodians can designate those dividends, those interest payments that are actually coming in off of your investments, and essentially just transfer those over just like a normal bank transfer to your first bucket. Keep in mind, again, both of these buckets, number one and number two, are taxable. So anytime you do get that dividend, that interest payment, that is reflected on a brokerage tax form at the end of the year. So that's going to be a 1099 form that you're going to provide to your CPA, and then that's going to be something that you're going to be providing to them at the end of the year. So just keep in mind, you're going to have one of those forms at least, depending on how many accounts you have, for those assets to be able to report that. So for bucket number three, this one is a little bit trickier just because there is a little bit more coordination involved with kind of that third bucket. If we are putting all of our traditional IRAs, traditional 401ks, those monies into, or those assets into that bucket number three, then a large percentage or the majority of those might actually be taxable, and we have to coordinate those withdrawals with our tax plan for the year. Also, too, another factor that plays into how much we're taking out is required minimum distributions. If you're over 73, those can dictate really how much you have to take out because it is required. So making sure that you are aware of what those amounts are prior to the start of the year, before you kind of designate how those asset allocations are looking across your revocable trust, your joint accounts, any of those other taxable payments that are coming in. Those are all going to be added to any type of traditional or 401k distributions that you're taking out, and again, going on your total tax reporting for that year. Um, as far as when you're taking that money out, a periodic distribution can a lot of times help to alleviate kind of some intra-year fluctuations. So whether that's market fluctuation or income fluctuation, those things can kind of sway one way or the other depending on how the market goes for the year, as opposed to doing kind of a periodic distribution schedule that really tends to kind of even out that retirement income and allow you to kind of again be more of a steady middle of the road distribution plan. In bucket number four, again, if we have that set up with those Roth IRAs, those tax-free buckets, there's no tax implications if any of those distributions are qualified. So the great thing again about those Roth IRAs, 401ks is we're not having to worry about the taxation upon withdrawal because we've already paid the tax when that's gone in. So again, we talked about the purpose for that being more for that growth mindset, and again, continuing to give us that retirement growth for that income down the road. However, if there's no other income buckets to really pull from, you can pull from these if there is a tax situation or kind of three main scenarios. So those scenarios typically are going to be if you are going to be pushed into a higher income tax bracket. So that could be if your income is higher than expected for the year, you have kind of multiple layers of income all at once that can push you into a higher tax bracket. Some of those are close to a double what the previous one is. So for instance, the one the third tax bracket is a 22% bracket right now as the tax code stands. So every 22% of every dollar in that bracket is taxed. The one right below that is only 12%. And so if we are able to stay in that 12% bracket, that's almost a 50% savings. And doing that might make sense to pull from that fourth bucket if that's a decision we have to make. The next one is going to be, and I apologize, two examples here, not just three, or not three, but the next one is going to be is if our Medicare premiums are at risk of going up. So if you are a Medicare age, 65 or older, the income related monthly adjustment amount, which is called IRMA, kicks in if you start making more than certain thresholds, depending on your tax bracket for that year. And so the married filing jointly brackets are going to be higher than your single brackets. But if you're pushed into those brackets, that could potentially end up in a several $100 monthly increase, which is not necessarily a tax, but it is a surcharge, and it is related to what we could potentially avoid by taking money strategically out of the right buckets and the right plans. Taxes as it relates to distributions right now. This is a slide that we thought we'd share just as it relates to planning for the year and looking at 2024, 2025, and then on into 2026. So right now, as it stands, the current 2017 Tax Cuts and Jobs Act is set to expire at the end of 2025. What that means is that all of the higher brackets and the higher standard deductions are set to actually cut in half and revert back to their normal levels starting in 2026 for that tax year. So that means that a higher, less spread out tax rate system is scheduled to be implemented here in 2026. And after the election year, we will begin to see more clearly what's going to happen, if this will continue just to stay its same course, or if we do see that there's any corrections to this. But right now, as it stands, those brackets are scheduled to go up. Case in point, basically that taxes are not going down, and keeping that in mind, making sure we're taking advantage of that now is going to really allow us the best opportunity to go ahead and capitalize on low tax rates now, and various strategies involved to capitalize on that could help you make sure that you're not paying tax or paying tax more than you have to. So one of the last things we'll go into here is just kind of those those scenarios where we run into when what time should I really be moving money between these buckets? Whether it's taking profits out of my bucket number 4 and distributing those back into bucket number 1 to really replenish the money that I had lost, or taken out because the markets maybe dropped temporarily, those types of things. Well, Here's just a few ways to consider how to really manage that distribution schedule and make sure that you're, putting those money in the right places. First of all, there's obviously lots of influences that affect, when we distribute money, when we take money out, when we move it around. The two main, factors that it boils down to are internal factors. Typically, your lifestyle changes, whether it's retirement, whether it's going and deciding to, spend more time with, family or different part of the country or, different house change, things like that, job changes. Those can really affect any type of your plans for that distributions going forward. And then we have our external factors, things like market volatility, just overall interest rates, geopolitical concerns, things that are outside of our natural control. So, first scenario for moving money between different buckets. First one is going to be when we see the stock market's up, and so we know that stocks are affected by various factors. Typically you're going to see where money market rates, savings rates, things like that are not as affected. Um, there can be other factors involved, but typically, only your, kind of the money that's in the market is going to see that big lift. And so if we see markets, going up, really our main two buckets are not going to see, much of a change. So not a huge increase there or difference with what we're doing. However, with buckets number three, we may see that those assets are appreciating, that we're seeing those account values grow maybe above where we originally started or where we've seen them in the last, near term. That can be a good time to go ahead and take some profits. Again, strategically looking at our tax rates for that year, and if we see a shortfall in our buckets number one, buckets number two, going ahead and replenishing those when we do see that the market's given us, that favorable time, can be a good time to do that. Not something we like to see all the time, but if we see the market is down, the primary movement in this bucket, which is what again we have that bucket number one designed for, is just going to be to continue to stay the course in those higher end buckets from 2 to 4, and take those withdrawals out of bucket number one because that's what it's there for. Having that war chest, having that money in that bucket is going to be that's not risk. There's no risk in that bucket at all. To take that money out. And so that's the best place to pull that from. You're leaving those assets, in the right places in the other buckets to be able to capitalize on any market rebound and recovery and not selling at that market low. When we look at bucket number two in this case, again bucket number two, we shouldn't see much of a fluctuation if the market is down. So looking at when those maturities are coming due, whether it's 3, 6, 9 months down the road, that can be a time where if we're pulling more money than usual out of bucket number one, as the market is down, taking the actual principal of those CDs. And putting that whole amount back into bucket number one to do that replenishing can be really the best way to make sure that you're giving your growth assets as much time as possible to go ahead and recover. Keeping funds invested in those third and fourth buckets, again, systematically rebalancing. Sometimes markets go on a little bit of ebbs and flows. If we do see a bear market or even just a correction, sometimes we see kind of some testing of some lows, and what happens is the market will maybe drop down even farther than where we think it's going to be. Those can be great times to go ahead and do a systematic or a strategic rebalance. Even if you've just done it, setting a threshold, say a 5-10% drop from where you previously rebalanced, can allow you to go ahead and again buy back in at those lower prices and really speed up that rebalancing process. Shifting timing of RMDs, required minimum distributions. So this can also be another way to capitalize on the market changes throughout the year. If we're over age 73 again, you have to take out those required minimum distributions. If we start the year and the market's already seen a 10-15% correction, maybe not necessarily getting that RMD if you're used to taking it January 2nd of every year. You may be going ahead and waiting towards the middle end of that year to take that distribution out. Can go ahead and alleviate some of those selling times when the market's down. Again, setting up kind of periodic distributions as well can help to smooth out that curve. So there's a couple different strategies that we can do when it comes to just timing throughout the year. Again, visiting with your financial professional, making sure that you're doing this in line with your strategy, in line with what they're seeing with the market is a great practice to have, and coordinating with them. A third strategy or third scenario we see, kind of when it comes to moving money is going to be a charitable giving. It's a really great way to get a tax deduction if you are charitably inclined. But pulling from assets other than cash is typically going to be a more tax favorable way to donate, as opposed to just selling and giving cash, or giving out of cash flow. So one thing that you would want to look at is if you have those appreciated securities in those taxable accounts. So whether it's a joint account, individual account, revocable trust. If you have purchased a security, you purchased a stock, mutual fund, ETF, and you've seen that investment actually increase in value, you can go ahead and actually transfer those assets directly in kind to a charity that you support. And instead of actually selling that investment, you're actually transferring that over in kind. And what that does is that actually allows you to transfer the entire market value of that investment. Your charity gets the entire investment portfolio, not just what's after tax and after you've sold. In most cases, you also can get a deduction on the full fair market value of what you donated, up to a certain amounts of your adjusted gross income. But that does allow you to also get a higher tax deduction, as opposed to just selling and donating cash. A second strategy, if you are charitably inclined, is to go ahead and just donate from your IRA directly to your charity as a qualified charitable distribution. So what this does is allows you to get a tax exclusion on the amount that you've actually contributed to your charity. And then it still allows you to get the full standard deduction if you are not itemizing your tax deductions. So that allows you to really kind of double dip as it relates to your tax savings for that amount. It also does satisfy your required minimum distribution if you're over age 73. So there's a lot of other benefits to that too. So there's not always you know, a advantage to taking that money out when the market is down. So we don't want to just get sell an investment because the market's down just to get a little bit of a tax savings. However, if the tax savings is significantly valuable and you are in a higher tax bracket or maybe even a medium tax bracket, that tax savings, even when the market's down, can go ahead and be a valuable savings more than going ahead and donating just cash. And so keeping that in mind, again, coordinating with a financial professional who knows your situation is a very valuable practice to take in these cases. If you do go ahead and do the qualified charitable distribution, that's typically one of the only times it makes sense to go ahead and move money out of the third or fourth buckets in a down market, to go ahead and get those big tax savings. So, last couple topics here that we'll cover is, again, we talked about those lifestyle changes. What happens if we see that, things change in our lifestyle unexpectedly, whether that's income or that's, maybe expenses going up, whatever that may look like, tax rates as well. So, if we see that income is expected to go down in later years, so again, kind of the main concept premise of retirement and deferring income is that we can pay a lower tax rate down the road. So if it's possible to defer those distributions and make sure that you're taking that money out when you know that your income is going to be lower, that can be a good thing to do, and not have to pay that tax that you're going to pay that's higher now. If your income is expected to go up, then accelerating those distributions during that time frame when your income is down is again going to be a better practice of paying the tax on that money that you might have to take out. And then being able to still take that out and use it for what you need, but just realizing those tax implications in the year that your income is down. So covered a lot. There's obviously a lot of mechanical and financial strategies involved with this strategy. So definitely there's no one size fits all. It can definitely affect different people in different ways. But there are 5 different ways that you really allow you to sustain this strategy over the long time frame. The first one is to, again, don't short that emergency fund, that war chest of money that's designed to provide you that stability. That's really going to be a key factor for you when it comes to making sure that your assets are staying in the right places. When taxes are low, taking advantage of those. So not making sure that, or again, not taking those money out those monies out when your taxes are high. But again, when taxes are low, I didn't say zero, but I said when they are low, allows you to make sure that you're not necessarily always paying the lowest tax rate, but you're not necessarily paying the highest tax rate as well. And you're exercising some care when it comes to the tax implications of your withdrawals. Don't panic in a down market. Kind of is a hard thing to do. It's easier said than done. But again, in a down market, those time frames that we see the market go down, really making sure that we're having that disciplined approach, not selling at the wrong times, locking in losses, but making sure that we are having a disciplined view of the economic side, not just the tax side. Sleeping on big decisions, kind of is that old sage advice maybe that your grandma might have given you over time, but it does ring true. Just making sure that you're giving yourself adequate time to process those big decisions, making sure that you're not jumping on anything that's irrational, and again, coordinating those with those you trust. Finally, working with a trusted advisor allows you to get a lens kind of that is maybe outside of your own, getting that third party perspective, allowing you to really filter through all that stuff that you've heard. Maybe that's not going to be a benefit to your situation. It might be a good thought, but making sure that it's actually appropriate for you yourself too. So those are 5 other key areas that allow you to really continue that sustenance of that retirement strategy over your long time frame. So this point looks like we've came to the end of the webinar. So we'll open up for questions. Again, we appreciate everyone joining us and making sure that you are well informed when it comes to this strategy here. So let's see. We'll go through these here in just a minute. All right. All right. So it looks like the first question we had come in. It's going to be as it relates to rental income. So, what bucket does rental income fall into? So, rental income is it's a fairly stable income, yet at the same time, it does have risk associated with it. So, rental income is really going to supplement that medium-term bucket, that bucket number 3. So that is taxable for income tax. It's not an employment tax that it's taxed by for active income, but it is still subject to passive income tax. And so yeah, you still would pay some tax on that, but it's going to fall kind of in that bucket number 3. Let's see. Changes to the bucket strategy when interest rates go down. If interest rates do go down, that will affect the yield that we're making on our savings, bucket number 1, bucket number 2. When we see those rates start to drop, that's, kind of a sign to go ahead and lock in as high of a rate as we can during the time that we see those high rates. So, case in point is kind of actually, right now over the next couple months, the Fed has indicated that there might be some rate decreases between now and the end of the year. So with that, we don't know when the kind of the drop dead date, so to speak, is. So that interest rates will continue to drop, but we do know that it's going to be a slight bit forecasted. So continuing to lock in high rates now, if you have investments that are maturing, that are maybe short term, going ahead and buying those long term maturities now, locking in those rates. Another thing is, as those, if we get a few years in and, obviously we've had those higher rates mature, say 2-3 years from now, where rates are, hopefully significantly less than they are now, going ahead and increasing the short end of our second bucket. So the bucket number 2, so whether that's a, 3-month CD, 6-month CDs, as opposed to having everything in bucket number 1 in just a savings or just a high yield account, having very short-term maturities can also allow you to increase the overall interest rate that you're getting, not necessarily just having that all in cash. You do, again, want to make sure you have enough to be able to sustain you. But a lot of times if you have, say, 18-month or a 20-month cushion in your bucket number 1, you can a lot of times, kind of push that second bucket out a little bit and have a little bit more heavyweight into those shorter maturities. And that will still allow you to have that liquidity for 0 to 2 years. All right. Another question. How would you change the strategy if you wanted to make a large charitable contribution? Charitable contributions, again, are going to give you that tax savings when it comes to income tax, but making sure that you are looking at things other than cash first is really the key. So, looking for your most tax friendly donation candidates are going to be the first priority. So, in your joint account, revocable trusts, individual accounts, any of those investments that have maybe appreciated in value, and you're seeing that as a gain on your statement now, or you're seeing that green. Appreciated value on that right now that's attached to it. Those are absolutely some of the best donation candidates you can make. So, there are a few stipulations. Your church or charity has to have a brokerage account set up first to be able to transfer those in kind. But transferring those assets gives you an immediate, tax savings on what you would have paid in capital gains tax, and allows you to satisfy just a bunch of different things all at the same time. Another thing would be is if you are over 70 and a half, even if you're not required to take money out of your IRA, going ahead and making those contributions with IRA monies now, that's going to go ahead and provide you still that tax exclusion, but allow you to get that money out of your IRA without paying tax still. So there's a couple of other intrinsic benefits to that. Um, if you are taking money out of maybe bucket number 2 before bucket number 3 or number 4, replenishing that bucket number 2, if it goes, lower than what you'd expect from bucket number 3 or 4, can be also something you can do at this point. Looking at kind of the overall market outlook with an advisor, making sure that you're talking through those things with your plan. Those are important to do if you were to be doing that. And the last point in that I would say would probably be to to tell your advisor or tell someone you're working with ahead of time, making sure that they know that you're doing this. And if they know that you're doing this, you can kind of plan that out in advance. So that would be my suggestion on those 3. I don't see anything else coming in. So I appreciate everyone joining us today. If you are interested in learning more about us, our firm here, we are accepting new clients. It is something that we'd love to explore your situation on, whether it's retirement income, whether it's looking at just your overall retirement plan. If you're still in the accumulation phase, still working, we can definitely set up a call to determine what's the best fit for you. So if you scan the QR code on your screen, that'll take you right to our contact page. We'd love to visit with you. We'd love to understand more about what you're hoping to accomplish. We love working with people from various walks of life, and we certainly welcome the opportunity to look at your situation as well. So with that, we will go ahead and sign off for this evening. Again, we appreciate everyone joining us tonight, and we'll have the recording posted within a few days, and you'll be able to see this on our website as well. Thank you everyone for joining us, and have a great evening.